Today's the 4th of October 2021. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500 with a quick hop across the oceans to the FTSE, and then we're going to spend a few minutes discussing gold. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So let's start with the analysis that I've been starting these market updates with for several months now, the S&P 500. This is still my preferred analysis, although my preference might be shifting a little bit because of the recent bearishness, which doesn't fit very well with this particular analysis, but certainly for the time being and over the past several months, this has been my preferred analysis. And of course, the important thing about this analysis, as I have mentioned in pretty much every market update video that I've recorded since sometime in July or perhaps early August, the important point about this analysis is that the 18-month cycle trough occurred on the 19th of July. That's according to this analysis. And so what has happened since then? Well, if you go back and take a look at last week's market update, you will know that we were discussing the possibility of an 80-day cycle trough forming over here in the last week of September. Well, I think that's about the 20th of September. And if you take a look at last week's market update, you will see that there were a set of hollow diamonds under there. And as I explained in last week's market update, the fact that there are hollow diamonds means that Sentient Trader has tentatively positioned the trough in that particular position on that date. And of course, those hollow diamonds have disappeared. Why have those hollow diamonds disappeared? The reason they've disappeared is because we now have a new low. And although it is just possible that an 80-day cycle trough formed then, and that we have already seen prices slipping to a lower low than was formed at the 80-day cycle trough, it's very unlikely. And so you can see that the analysis has been changed, and that stack of diamonds has moved and it's been replaced by the nest of lows for the 80-day cycle trough, which is now looking a little bit broken. I think you can see the 80-day and the 40-day cycle trough are off to the left and the others are off to the right. So that nest of lows is looking a little bit broken. And in last week's market update, of course, I discussed the fact that by watching the 20-day FLD, we could have been cynical or skeptical perhaps about the formation of the 80-day cycle trough because of the fact that price came back up to the 20-day FLD and pretty much found resistance. It was fairly approximate resistance, but it found resistance at the level of the 20-day FLD, which is of course what we would normally expect at a G category interaction with one final move down into the 80-day cycle trough. And so potentially that is what has happened, and we might have seen the 80-day cycle trough forming on Friday of last week, but there's certainly no confirmation of that yet. And so that is what happened last week, and this is the situation now in my preferred analysis. Nothing really has changed apart from the fact that it seems likely that that 80-day cycle trough did not form at this particular time on the 20th of September, but potentially formed last week on Friday, or possibly price could still come down a little further to form that 80-day cycle trough, or perhaps something else is happening in terms of the analysis. So we're going to take a look at the other analyses that we've been tracking in a moment. I'd just like to point something out, that is that there have been 77 days since this trough in July. On the 19th of July, the average length of an 80-day cycle is 68 days. And if you don't understand that, make sure that you download the PDF document 10 Core Concepts of Hurst Cycles, which explains why the average length of an 80-day cycle is 68 days. That's one of the things it explains. And the recent wavelength of the 80-day cycle has in fact been 65.5 days, as you can see, according to this analysis. And so 77 days is making this a very long cycle. So we have some questions here in terms of the position of this 80-day cycle trough, and we have some challenges facing us. Let me take a look at some other analyses. I'm going to leave the zoom scale here at about that, and let's take a look at the other analysis that I have mentioned over the past several months about the S&P 500 in the videos about the S&P 500, and that is what I call the default analysis. Here it is, and as I mentioned in last week's market update video, there is no such thing as Sentient Trader's default analysis. It doesn't produce a default analysis for every single instrument in the tradable universe. There is no such thing as what Sentient Trader is saying. Sentient Trader is a tool in the hands of the analyst. And what I mean by default analysis is this is an analysis that I have not influenced in any way. The only way that I have potentially influenced it is by providing Sentient Trader with a certain amount of data to analyze. In this particular case, it just happens to be the amount of data that was present in this data file that I'm working with. And the other way in which I have potentially influenced the analysis on this chart is by choosing a start date for the analysis, which is again simply a matter of telling Sentient Trader how much of that data to analyze. I'm not going to spend time discussing that in this particular video, but the big difference here is that, of course, we have a 40-week cycle trough that I spoke about in last week's video that occurred fairly late at the beginning of March. Some analysts believe that is an impossibly late position for that 40-week cycle trough. Here is the 20-week cycle trough, which formed in the middle of July. So the difference between this analysis and the other analysis we were looking at a moment ago is in the magnitude of the trough that formed in the middle of July. And so there's quite an important point to make about that, which is that although different Hurst cycles analysts will often have different analyses that they are looking at, and one Hurst cycles analysis will often consider various different possibilities or alternatives, the difference in the analysis will usually boil down to a simple matter of magnitude at a particular time. So in this case, this trough in the middle of July was either of 18-month magnitude or potentially of 20-week magnitude. And we're going to take a look at another analysis in a moment, which might be different, although I think it's still a 20-week cycle trough that formed there. And so the interesting thing about taking a Hurst cycles approach is that when first you come across Hurst cycles, you think that's a huge difference. Wow, 20 weeks compared to 18 months. But because we're working with a structured nominal model, which is simply a list of cycles that have harmonically related cycle wavelengths, when you have a difference in magnitude, the difference in terms of our expectations is not as different as you might expect. And I have been demonstrating this in the past several market updates. And in particular, of course, the difference here had to do with the expectation that we had last week or over the past 2 weeks. And here you can see there was effectively no difference. So I've explained this, what might seem to be an anomaly. We're looking at two different analyses, and yet in both of these analyses we were expecting an 80-day cycle trough to form last week. Or, we had the potential trough that formed here on the 20th of September, and then another potential trough that formed on Friday of last week. And so the interesting thing about these two analyses is that although they are different, our expectation recently has been pretty much exactly the same. And so there is nothing more to say really about this analysis because of the fact that our expectation was exactly the same, and the argument in terms of price coming down into this 80-day cycle trough is exactly the same. And I don't even need to show you the 20-day FLD here, although I can. There is the 20-day FLD, and as discussed in last week's video, the FLD is in fact in exactly the same position, and so we have exactly the same argument. So it doesn't really matter which of these analyses we're looking at. We are still considering the position of the 80-day cycle trough. Now let's take a look at a third possible analysis, and I haven't presented this particular analysis in these market update videos before, but I made a comment at the end of last week's market update video about the fact that the 18-month cycle trough would have been due, I think it was about 2 weeks ago, purely on the basis of the wavelength of the 18-month cycle. So let's take a look at that. So here is an analysis, and the comment that I made in last week's market update video was the fact that the average length of an 18-month cycle is 546 days. And I pointed out that 546 days from the trough in March of 2020 was in fact the 20th of September. So that was that low point. It was at exactly 546 days, which is the anniversary, if you like, although I don't think you can call it the anniversary, but it is the perfect wavelength of the 18-month cycle. And that very often, when you get a perfect wavelength, you will see some kind of a demonstration of a trough forming in the markets. And we had a comment very sensibly asking, why is it not possible that the 18-month cycle trough is forming round about now, seeing as it has been the correct wavelength has elapsed? And my reply to that, which I would like to expand on a little in this video now, is the fact that the wavelength is not the most important factor when it comes to performing an analysis. What is more important is the complex puzzle that needs to fall into place when you are performing an analysis. A Hurst cycles analysis is very much like solving a very complex puzzle. And the puzzle is although solving it is quite complex, the puzzle itself is very simple. And it is simply that each of the shorter cycles need to form troughs that are both clear and obvious troughs in terms of the price action. And they, of course, also need to be synchronized because of the principle of synchronicity. And so the fact that we identified 546 days over here on the 20th of September is less important than the fact that the shorter cycles are all falling into place, and they have been found to be positioned correctly. You will notice that in this particular analysis, I have actually influenced the analysis. You can see this pin symbol, which means that I have had to influence Sentient Trader in the position of the 40-week cycle trough, which you can see here has been positioned, I think that's right at the beginning of February. It might even be the 1st of February. So I have influenced the position of that trough. And in doing so, it has enabled Sentient Trader to come up with an analysis that is a fairly reasonable analysis. There aren't many reasons to reject this analysis. Each of the major troughs that we're looking at this particular zoom scale are beneath fairly prominent cycle trough positions over here in terms of matching the price action with the analysis. So it is a fairly reasonable analysis, and it's one I've been keeping my eye on. But what is it that makes this analysis less likely, in my opinion? And the reason why I think this analysis is less likely comes down to the finer details of that analysis. If you show most Hurst cycles analysts this particular analysis at this zoom scale, they would probably say it looks like a fairly reasonable analysis. You have prominent troughs positioned below prominent troughs in the price action and so forth. So where is the problem with it? Well, the problem with it comes when you start looking at the finer details. And the finer details here are things like this 80-day cycle trough, which is actually phased in this analysis pretty much over here. And so that's a very poor position for that 80-day cycle trough. It's not a good resolution, if you like, of the puzzle that we're trying to solve. And if we zoom in a little bit, I can demonstrate again some more of my difficulties with this particular analysis. So if we zoom into this scale, things look fairly good. But let me display the 20-day FLD. You will know that we track a sequence of interactions between price and the FLD. I speak about it in every single one of these videos. And it is in the sequence of interactions recently that alarm bells have been going off for me in terms of this analysis. And that's why I haven't really been presenting it, because when these kinds of alarm bells go off, I think it's a reason to really question the analysis. In fact, I have discussed it in a previous market update video when I discussed the fact that price came down and found support at the level of the 20-day FLD at this position over here, and then it came down and achieved its target and got no further. And phasing that trough here in August as a trough of the 80-day cycle with that kind of interaction surrounding the 20-day FLD is questionable. It's not entirely wrong, and this is where people struggle sometimes with Hurst cycles. They are looking for hard and fast rules. What means that that is wrong? Why is this analysis completely wrong? And the difficulty is there aren't really any absolutely hard and fast rules. It is a matter of applying what Hurst described as the art of a phasing analysis. Hurst himself said that analyzing a financial market according to the cycles present in that market is as much, if not more, of an art than it is a science. And that's where this kind of thing comes in. And I'm going to point these out to you, and you can pause the video and spend some time thinking about it. But in terms of this analysis as it is presented here, if this was an 80-day cycle trough that formed in August, we would have seen an A category interaction over here. In fact, let's just clear this so that I can make my point, and let's zoom in just a little bit here, and let's just label them a little more clearly. So here is our A category interaction. Price came up and it achieved its target, and that was all good, nothing wrong there whatsoever. But around about the time of the 20-day cycle trough, price should find support at the level of the 20-day FLD. There was absolutely no indication of price finding support anywhere near the level of the 20-day FLD. Of course, we see that in other markets as well, so there's nothing, again, that completely denies it, denies this analysis, I should say. But the important thing here is when price came down, moving into the 40-day cycle trough, which is the trough that then occurred on the 20th of September, that was the D category interaction, and we would expect price to find its target, achieve its target, and then cross back up above the 20-day FLD as it bounced out of the 40-day cycle trough. Well, it didn't really do that. It came up and it found resistance over here, which is not a good E category interaction. And then the F category interaction would potentially be this one over here, where price came down and dropped below it, below the FLD, I should say. So that's just not making sense. I'm not going to dwell on this because I want to get onto some other topics in today's video, but I hope that that demonstrates why this analysis is not my preferred analysis. However, I do think it is very important to keep an eye on not all of the possible analyses, because there might be many of them, but enough of them so that you can decide at what point your analysis focus should shift from one analysis to the other. And a very useful tool for doing that is the composite model line. So let's take a look at the composite model line in each of these analyses. And so let's start here with my preferred analysis, which is this one over here. Turn off the FLD. Let's display the composite model line. Now, the composite model line for this analysis, my preferred analysis with the 18-month cycle trough here in the middle of July, indicates, as you can see, that we are expecting price to bounce out of the 80-day cycle trough. That you're going to find is going to be in complete contradiction to the potential of price already moving down to an 18-month cycle trough forming very soon. Then we are likely to experience a late peak, and I mentioned this in last week's video, we're going to experience a late peak for that move and then a shorter and less impressive move down into the 20-week cycle trough, which you can see here. It's a bit of a staggered nest of lows, but it's expected to occur in the end of November. So that is our expectation according to this analysis. Now, I'd just like to point something out. Sometimes when I speak about my expectation, people assume that I'm recommending jumping into long trades and things like that. Our expectation is the first part of the thinking process. You have to be watching your cycle tools and things like that before you start jumping into trades, of course. So the fact that we have an expectation for a move out doesn't mean that you're immediately entering into long trades. I just felt I needed to clarify that. Sometimes we get comments saying, that long trade didn't work out, whereas I'm not yet speaking about a long trade. I'm speaking about an expectation. I hope that makes some sense. Okay, this is our second analysis, the default analysis. And again, if we take a look at our expectation here, you can see that it is fairly different. But we are still expecting price to move out of the 80-day cycle trough. And this makes for an interesting comparison. Go back to last week's video and compare the move out of the 80-day cycle trough, which I think you will see has been diminished a little. We're not expecting quite such a strong move out of this 80-day cycle trough as we were expecting last week. But the important thing is we would be expecting an early peak out of this 80-day cycle trough. And then, of course, market is going to move down into this 18-month cycle trough, which, according to this analysis, is expected at the end of this year or perhaps early next year. Now, what about the November trough? Well, there is still a trough according to this analysis. Remember the fact that we have a nominal model, and even when you're looking at different analyses, you would still expect troughs to form at about the same time. And so we would expect a trough here also in about late November. So the difference between this analysis and the first analysis, my preferred analysis, is not actually very great. The biggest difference has to do with when this peak forms. If we see an early peak forming, then our preference will shift towards this analysis. If we see a later peak forming, then of course our preference will stay with the other analysis. What about the third possibility that we have discussed in today's video, which is this possibility over here, that the 18-month cycle trough is nearly upon us? Well, if this is the analysis that turns out to be the correct one, then we are still expecting a bit of a move up, but you can see it's a very small move up because it is only in fact a move up out of a 20-day cycle trough, which is expected over there. So it's going to be a very small move up. Then we're going to experience an early peak and then of course a stronger move down into this 18-month cycle trough. I hope that you can see that with each of these three analyses, we're expecting similar behavior from the market. Each of the three analyses is telling us to expect some kind of a move up because there has to be a trough of some magnitude forming, or that should have formed last week. So we're expecting a bit of a move up. We're going to watch that and see where that peak occurs. And depending where that peak occurs and when that peak occurs, we will be able to refine our expectation further. I do hope that that makes sense and has provided an interesting glimpse at how we handle the unfolding of a Hurst cycles analysis as time passes. Now, I would like to skip across the oceans and take a look at the FTSE quickly. One of Hurst's principles is the principle of commonality, which tells us that markets move with a great deal in common. And one of the results of the principles of commonality is that stock markets around the world tend to form troughs of the same magnitude at about the same time. Now, I say of the same magnitude, but that's not necessarily true. Sometimes a stock market in one country will form a trough of 80-day magnitude, whereas the stock market in a different country is forming a trough of 20-week magnitude or 40-day magnitude. The important thing is that they move with a great deal in common, and very often they are forming troughs of the same magnitude. So here is the FTSE, the index from the UK. FTSE 100, and of course we have the same 54-month cycle trough that formed in March of 2020. Here is the 40-week cycle trough that formed at the end of October, according to this analysis, and you can see the cycle shapes, or the shapes that have been formed in this price action, are different to the price action in the S&P 500, and so we get a different placement of the cycle troughs, but there is a great deal in common. I'm not going to spend too long discussing this analysis because I want to focus on what's been happening recently. I'd like to point out that I've made a small change to this analysis. I've influenced this analysis. You can see the pin symbol over there, and that's because of this apparently triangular action that formed over here. And in my experience, the correct placement for a cycle trough is very often the final low point in the triangle, as opposed to the lowest price point in that triangle, which is where Sentient Trader wanted to position that trough. But you can see that according to this analysis, and I haven't influenced it very much, it's only that 20-week cycle trough that I've influenced, the 18-month cycle trough is here on the 19th of July, or at least in the middle of July. I'm not sure it's exactly the 19th. So let's zoom in and take a look at what has happened here. When there is confusion in one market, such as we have had recently in the S&P 500, it's very useful to take a look at other markets around the world, particularly primary markets such as the FTSE 100, or the DAX is also another very good market to look at when you're considering stock markets. So here are the important things that I wanted to mention. We had an 18-month cycle trough over here, and yes, indeed, that was the 19th of July in the FTSE. And you can see this analysis is still showing the analysis we were considering last week in the S&P 500 with the 80-day cycle trough over here on the 20th of September. We have a perfect and almost textbook sequence of interactions with the FLD, the 20-day FLD over here. I'll let you look at those and enjoy them yourself. There is the F category interaction as it drops down. Here is the G category interaction, finding perfect resistance at the level of the 20-day FLD. Then the H category interaction, bringing us down into the 80-day cycle trough. The reason I'm showing you this chart is because it still seems likely that the 80-day cycle trough has formed in the FTSE. Of course, it's not impossible that the market's going to keep coming down, and we could explore other analysis alternates in the FTSE, but we're not going to spend time doing that here. What is important is that the 80-day cycle trough seems likely to have formed in the FTSE. And yet in the S&P 500 and the US markets, price came down and formed a lower trough at the end of last week, as we've been looking at. So what is the difference? And what happens when you get one country forming a trough and the other country seems to confirm it, and then it moves away and it is no longer confirmed? What is the meaning behind that? Well, what often happens in this kind of situation is you get what Hurst called fundamental interaction. Fundamental interaction is when the news events that surround us interact with price movements, they influence price movements, and they tend to distort the cycle shapes, or they cause a bit of a kink in the cycle analysis. Now, this is a very complicated subject, and I'm not going to get into it here. Many people believe that, of course, financial markets are influenced by news events, and indeed they are. And there's a complex relationship between news events and the financial markets and cycles. And I don't have time to discuss it in this video. But fundamental interaction in particular is where you have a particular news event happening, or a reaction to a news event of some kind, or some kind of fundamental consideration, and that tends to distort the price action because it influences the price movement in a way that cannot be accounted for by purely analyzing the cycles. And potentially that is what happened in the US markets last week. I would like to spend just a few minutes taking a look at gold, because gold is presenting us with a really perfect example of what has turned out to be one of the themes of today's market update, which has to do with the way in which the magnitude of the cycle troughs can shift slightly in our expectations, and the way in which we handle the progression of a Hurst cycles analysis through time. And so I'm going to take us back in time. This is just a screen grab. You can take a look at this video on YouTube. This is the previous market update that I did on gold on the 6th of September, so just about a month ago. And I've just paused this video at about the 16-minute mark, and you can see the expectations that I was speaking about. In particular, you will notice a few important things. First of all, we were looking at an 80-day cycle peak forming at about the time that I recorded the video on the 6th of September. And you can see from the composite model line, price was expected to move down, then come up, form another peak, and then move down into a trough over here. And I can't really see that date properly. I think that is a trough in October, is it? I can't see that date perfectly. But you will notice that the 18-month cycle circle was over here as well. And in that market update video, I discussed the possibility of the 18-month cycle trough forming over here. I believe I'm correct in saying, but the important thing is that there was a circle over here, and so we had a potential low point over here, and we also had this nest of lows. You can see I've made a bit of a mess of this chart by drawing over drawings that were made over the original chart, but I hope this is making some sense. So this was our expectation for the move that gold was going to make. And of course, I should always mention when speaking about gold that the peak analysis is probably the better analysis to track, the more important analysis, and the most important thing we were expecting at that time was a peak of the 80-day cycle. So now let's take a look at gold right now and see what has happened. Here we go. I hope I have roughly the same zoom scale. So let's speak about what has happened, and particularly what lessons we can draw from it in terms of the way in which a Hurst cycles analysis unfolds over time. In particular, the time at which I recorded that video, which was on the 6th of September, was over here. And I was speaking, you will remember, about a peak forming, an 80-day cycle peak. And there is that 80-day cycle peak that has now been found in the analysis, and so that was something that played out exactly as expected. What happened next was that, of course, the price fell, which is what was expected, and then we expected price to come up again, and then the important thing was move down into this trough over here, or I say this trough. We were expecting price to move down into a low trough, which at the time I was speaking about as an 18-month cycle trough. So we were expecting a move down, a bounce up, and then a move down again. Okay, and I pointed out the 18-month cycle circle, which was somewhere in October, somewhere over here. So now some time has passed and the analysis has changed, and some people find this very disconcerting. This analysis now places the 18-month cycle trough over here, which I believe is a possibility that I mentioned in the market update video. If I didn't mention it, then it certainly was a possibility. If we go back and take a look at the picture again from that video, you can see here it is, you can see the whisker of the 18-month cycle certainly extended over that time, making that a possible position for the 18-month cycle trough. So in that video from the beginning of September, I was looking at a big 18-month cycle trough to form over here in December or early 2022. That would have been the nest of lows we were expecting a month ago. So how has that changed because of this analysis change? Well, in fact, moving the 18-month cycle trough to this position here in August has provided us with much neater nests of lows. We are therefore able to refine our expectation of when that important trough is going to occur. Now, some of you might say, but it was going to be the 18-month cycle trough, which now lies behind us, which brings me back to the point here, which is that when an analysis changes, our expectation of when these cycle troughs and peaks form in the markets doesn't change very much, but what might change simply has to do with the magnitude of that trough. So we are still expecting a trough over here, but it is now expected only to be a trough of the 20-week cycle. And whereas the previous analysis was leading us to expect price to move much lower, it is now probably not going to be indicating that price will move much lower because of the fact that the 18-month cycle trough has formed over here. Nevertheless, we are expecting a trough at about that time. And so what are we expecting now in terms of gold's price action? Well, we're looking at an 80-day cycle trough, which we are expecting fairly soon. It is just possible that it has indeed already formed. The peak analysis is still my preferred analysis to watch in terms of gold, and so we're looking at a 20-week cycle peak forming over here, probably sometime in November. So in very general terms, we're expecting a move up now into this 20-week cycle peak. What about that move down into the end of the year? Yes, we are still expecting a move down. But because it is probably only of 20-week magnitude, that move down is probably not going to be the big move down we were expecting into the 18-month cycle trough. It'll be a less impressive move down into a 20-week cycle trough. I do hope that you found this market update interesting and useful. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.